Hey, what's up, everyone? Time for another edition of Money Monday. And today, because it is, the end of Life Insurance Awareness Month, I figured it would be a good time to not only go over how insurance tax shelter works, but show you a practical example of how that looks. So, to quickly review, with an insurance tax shelter, let's say, for example, someone has an insurance policy and the premium. So, with that, the premiums will go towards not only an insurance side, but an investment side. So let's say, for example, the premium is $100 a month, and of that $100, $30 is the cost of insurance. The remaining $70 goes towards the investment. So not only is it being used as an insurance product, but it's also used as an investment vehicle. And next month they put in $100, $30 still goes to the cost of insurance, $70 goes towards the investment. That keeps going. So let's say sometime down the road, maybe a year later, person who's got this policy, they decide to overfund it. So instead of putting in $100 that month, they put in $500. So of that $500, $30 is still going towards the cost of insurance, but what's changed is instead of $70 going towards the investment, it's $470 going towards that investment, and just overfunding that investment. So that's how the investment side and insurance side of the insurance tax shelter works, and why people do this is as a retirement strategy. So let's say someone's got an insurance tax shelter, they're age 65, ready to retire, and they have $1 million saved up in there on the investment side. So they could actually withdraw that as cash, but they'll end up paying taxes on that. At the end of the day, we want to pay as little tax as possible. So what someone can actually do is they could use this insurance policy as collateral for a line of credit from the bank, and the bank will give them a rate of prime plus 1%. And depending on the types of investments in, they can give anywhere from 50 to 90% of the value. So in this example, let's say they got the full 90%. So they use that $1 million as collateral for a line of credit. They get a line of credit of $900,000. So they have that line of credit that they could use to spend in retirement, but they're not physically attacking that $1 million over here. So because that $1 million is still there, what's it going to keep doing? It's going to keep growing. So let's say 10 years later, age 75, that $1 million goes to $2 million. Now, because they didn't physically attack that $1 million here, let's say they're out of that $900,000 line of credit, they could use that as collateral and get another line of credit of $900,000. And they could use that to spend in retirement. And then let's say 10 years later, it's still growing, they're 85 and it grows to $4 million. Now, 85 is the average life expectancy in Canada. So let's say at this point, they pass away. So in total, they've borrowed a total of $1.8 million as a line of credit from the bank plus interest. So of that $4 million, so let's say the interest is $200,000. So they owe the bank $2 million. So for that $4 million, $2 million will go to the bank to pay off the line of credit plus the interest. And the other $2 million will go down to the beneficiaries tax-free. So that was a quick review of how that works. And I'm just going to quickly show you guys an example here. So in this client example, I just did it for myself, 32-year-old male, non-smoker. And I just, to show the value of this, I went a bit higher than someone typically would and did it for a monthly premium of $3,000 a month or $36,000 a year. So, year one, me putting in $36,000 a year, and this net amount to shareholders, what that means is pretty much what my beneficiaries would get at the end of the day. So I set it up from age 33 all the way to age 65, putting in $36,000 a year. And you're seeing that this number keeps growing and growing and growing. Putting in $3,000 a month for 33 years. Now I retired at 65 and I'm 66 and I'm decide I want $5,000 a month to spend retirement. So I can use the value. So by age 65, that value is just under $5 million in there. I can use that as collateral for a line of credit, and borrowing against it, I can have $60,000 a year or $5,000 a month to spend in retirement. So borrowing against that, so age 66, if I borrow against that, my beneficiaries, after the debts were paid off or whatever from that line of credit, they get still about $5 million because it's fairly early on. But because we're not physically attacking the investment there, you can see if I keep doing this, the number that goes down to my beneficiaries keeps growing. So fast forward to age 86, average life expectancy in Canada is 65 or 85. So I've been borrowing $60,000 against it from the age of 66 up to 86. So 20 years. Average life expectancy, like I said, in Canada is 85. So I pass away until my 86th year, pass away, claims are paid out. So the insurance pays out, the lines of credit, and then interest on that for this 60,000 I've been borrowing against it every year is paid out. And at the end of the day, my beneficiaries would get a total of $6 million. And that's only for putting in $3,000 a month for some 30 odd years. Now, like I said, in this example, I just did something a bit higher that someone would typically do just to show you the value of that. Of course, I'm not saying everyone should put in $3,000 a month towards it. It just depends on what you can do and if it's the right fit for you as well. But with this strategy, you can see how people can use this as a strategy, not only to have some income in retirement, but also leaving behind generational wealth for their family down the road. So with that, I hope you all have a great day, and I'll talk to you all later. Take care, and I'll see you all at the top.